Hello fellow traders, how are you doing? The first week of 2022 is already behind us and I hope you are able to catch some amazing trades with us. Gibson here from MrMTrades. Welcome. As you may know, it's pretty common that the markets are quite slow over the holiday and the beginning of the new year, as traders, banks and companies are taking a break as well. But still, we were able to catch some amazing trades. So if you'd like to join us, the links for our Telegram group are below. But now, let's get back to our main topic. The video you are watching is a follow-up, a run-through of a market structure PDF tutorial that we've posted in our group earlier this week, talking about market structure. So let's jump right in. One of the most important things traders want to achieve is a perfect, preferably the lowest price when entering the trade in order to get the most gains. We're talking about stock traders, option traders, forex traders, all the markets available to retail traders. They think that once they have this knowledge, they will be right 100% of the time. They'll know when to enter and when to exit the trade. And from that moment on, the profits will flow. I'm sorry to tell you this, but such a strategy doesn't exist. If you are taking advice from all the gurus and prophets out there telling you this, you are wasting your money. If there was such a strategy, we would all be super rich by now, packing our garages with Ferraris and Lambos. So let's start with the basics. When you first look at the chart, you see bars, patterns, prices, highs and lows, price going up and price going down. This, of course, can be a bit confusing for an untrained eye, but fear not. Let me walk you through it, step by step. The first step is called Know Thy Market Structure. A method of analysis of the basic movements of the price will also refer to it as price action. The knowledge of the basics of market structure will allow you to make better, conscious decisions as a trader, adding them to all of your other criteria arsenal, such as pattern recognition, support and resistance, breakouts, swings, and so on. Let's start with the basic price movement. What we have here is the line representing our price, creating higher highs and higher lows, lower lows and lower highs. Is there a particular reason the price moves this way? Well, there are quite a few, but one of the most important ones is the law of supply and demand. According to Investopedia, it is a theory that seeks to explain the relationship between the availability and desire for a product, such as security, stock for example, and its price. Typically, low availability and high demand boost the price of an item and high availability and low demand reduce its price. In other words, if the price of a product is low, but there's a large interest in it, or demand, the price gets pushed higher. On the other hand, if the price of a product reaches higher, but nobody is interested in it anymore, because it has become too common, or there was a lot of supply, the price gets pushed lower. Do you remember the situation with GameStop? A bunch of Redditors decided to buy the same stock, creating demand, and the GME price skyrocketed by 928% through the first few weeks of 2021. As for this picture, all you have to remember is that if the price tries to reach higher, it has to move in a certain way, creating higher highs and higher lows in an uptrend, and when it wants to reach lower, it creates lower lows and lower highs in a downtrend. And this is where we come to the three basic types of market structure. 1. Bullish trend or uptrend. 2. Bearish trend or downtrend. And 3. Sideways trend, when the price is ranging. The important thing to remember here is to always base your bias towards the price movements looking at the higher time frames. As the price seems to move a bit quicker on the lower time frames, we tend to base our views on those smaller moves, and they are important, but also can be misleading if we want to see the bigger picture. Why, I hear you ask? The answer is simple, but very important nonetheless. Remember that the market movements are fractal. Have you ever seen a lightning? Did you notice what kind of patterns it creates? First, a huge, thick bolt of lightning appears, and then from the bolt, the smaller ones emerge. That pattern repeats until all the electrical discharge is pushed through to the earth. It is vital to understand this concept, because what we see on a lower time frame has a completely different meaning on a higher one. Let's take a closer look at this concept, but on the price chart now. As you can see on the chart, we have a price in an uptrend creating higher highs and higher lows. The thing to remember here is that we only can confirm higher low when the previous higher high gets broken to the upside. So in this picture, we can't confirm that the higher low number 2 is a proper higher low until the higher high number 1 gets taken out by the price and another higher high is created. The price could just as easily reach the price point of higher high 1 and go lower, passing our higher low 2. As on the higher time frame, the 3 hours one, the price is still in an uptrend, creating higher highs and higher lows, etc. On the lower time frame, the price needs to create lower lows and lower highs in order to get to the 3 hours time frame lower low. Could the price go lower than lower low on 3 hours? Of course. That's why we don't buy or trade the dip, as we truly don't know when the dip ends. On the other hand, looking on the lower time frame, once the price has broken the lower high to the upside, we can assume that the 3 hours lower low will hold. And probability tells us that once there is a break of structure or price breaking the previous lower time frame lower high to the upside, it won't return below lower low on 3 hours. Instead, it will go higher. So we could safely wait for the price to retrace to where it wants to retrace, after it shows us the signs that it wants to break it higher, check the volume and other conditions and enter the breakout, placing our stop loss below the last higher low on the lower time frame. And that's one of the strategies we use when entering our trades, but that's a story for another tutorial. So to sum up, you won't be 100% of time right as it comes to price movement or entry. We look at the higher time frames to get what's going on with the price and to establish our bias. Price moves in a particular fashion, either uptrend, downtrend, or sideways. The market movements are fractal, meaning that the higher time frame patterns and moves also appear on the lower time frames. Establish the next higher high and current higher low, go to the lower time frame, look for break of structure to the upside, and find your entry point. Remember that this is just an introduction to the market structure. There are plenty of other factors that need to be considered before entering a trade, so please be patient. Check the charts and see if you can notice the same movements as discussed here. Try to get more clearance on all of this, go back to our chart and ask the questions once you have them. I tried to put everything here as clearly as I could, and I hope all of that makes sense. And if you liked this video and got any value from it, please smash that like button, write a comment and visit us on Telegram, for which you'll find the link below. We have a great group of like-minded people there. We are discussing our strategies and our trades, supporting each other in the process. So come and say hi. Have a great week, even better trades, and I'll see you in the next video. Take care.